The markets have had sort of a rocky road, can we say, so far this year. As you look forward, is there any real prospect they can recoup in the second half of the year?
Probably not totally. Let's start off, the market has recalibrated itself. We witnessed now a change in policy in the Federal Reserve. We raised short rates. So we saw a recalibration of growth stocks. That's principally the majority of the downfall. And yet the index are masking some of the problems because part of the index are energy companies, commodity companies that are up quite a bit. So if you look at the volatility in the market and the spread between winners and losers, it's pretty broad this year. And so we've taken out a lot of those gains that we saw during the COVID years and during the 2 years where we were, changing our lives and we were emphasizing different companies, and now we're seeing the reverse impact of that. So that was one of the foundations of it. But now there's greater recognition that inflation is not transitory. It is probably with us for a number of years. And it's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated. Demand right now in our economy is equivalent to the demand that we saw pre-COVID. And so we're witnessing all these supply shocks, and that's creating these attended price increases. And so it's more supply driven. It's been aggravated now, obviously, by COVID and lockdowns in different parts of the world where we are manufacturing goods. It has been further aggravated by the Ukraine Russian war and where we have supply shocks. But I have this fundamental view that much of the inflation has been generated by some very large policy shifts in the United States.
And I want to talk about exactly what caused it, but just before that, we have Jamie Dimon talking about a hurricane, potentially. Are you saying something that significant? What's the chance of recession? Not so much this year, but in 2023 or even 2024?
Well, I think Jamie said one outcome could be a hurricane. It may not be that. So I know that sounds so perfect for the media, a hurricane, but I could see scenarios where it could be quite bad, another downward draft of significance, and that's going to be dependent on earnings going forward. But I could also see a scenario where we're going to be muddling along for the next year or two, right around this level, and maybe up 5%, down 10%, but we're going to be in this range-bound area until we have better information. I mean, the one thing I will say with total certainty, we're going to be living with more uncertainty, and so with that in mind, we are going to have bouts of fear, which is going to bring down the markets, and a little more confidence going on forward. But we have not witnessed huge asset allocation changes by our investors.
Well, I was going to ask about that. What are you seeing in your funds, for example? Are people buying bonds again, for example, in your funds?
Oh my gosh! In the month of May, we had the biggest increase in ETF bond purchases. We had $30-something billion of inflows in bonds, whether it was credit or all that. So you were certainly seeing a revaluation of how far interest rates need to go upward. And so that's also one of the big trends. I mean, I'd say 30 days ago, many people were calling for a deep recession, and now people are mitigating that. Obviously, there are views that we could have a deep recession or a hurricane, but that's just one of the outcomes. I mean, I think there's higher probabilities of outcomes that we're going to be more range bound with a lot of volatility.
Certainly, there's uncertainty about exactly what happens with the Fed. Maybe not so much on rate increases as what the consequences will be of the quantitative tightening, which actually started this week. What are those consequences likely to be in your judgment?
You better find new buyers. I think the marketplace does not understand the dependency of low rates was on the QE purchases, the trillions of dollars at the Federal Reserve. But let's all be clear, between Japan and China, they own close to $2.5 trillion of U.S. treasuries too. So there are big owners and big players, and obviously what will be the future clearing price rates with less QE and now a reversal of it? Do we need to get up to a 3% 10-year to meet a lot more demand. And so much of this is we're all going to have to see what are the consequences. If the demand that we saw in intermediate treasuries in May carry on, QE may not be, the reversal of QE is not going to be as big of a problem. If we have that fear that inflation is going to be longer and higher, then obviously we're going to have to reset all that, and we're going to probably have higher rates. But I'm of belief that we don't have to have much higher intermediate and long rates.
For our global television, radio, and YouTube audiences, this is a simulcast with, of course, Larry Fink. He's the chairman and CEO of BlackRock. Let's go back to something you raised, Larry, and that is inflation. Not just what it is, but what has caused it. Because we've been told in the past, for example, from Chair Powell, that he's got the tools he needs to take care of it. Right now, the data don't necessarily indicate that he's taking care of it yet. Do we have the tools?
Well, first of all, I'm a strong believer in Chair Powell and the Federal Reserve doing the right thing. I have great confidence in his abilities to assess the market. So he may know a lot more than I do, so I'm not going to be judging him. I believe the problems of inflation are not Fed-related as much as policy-related. So I believe inflation is really based on some big macro policy changes that are now, that had good intentions, but the unintended consequences are more inflationary. For instance, post-World War II, America's foundation of economic policy was based on consumerism. We built this entire economy post-World War II with a belief that if more Americans can have more things, then we have happy Americans, and we built a whole geopolitical platform around that. And then with the fall of the Soviet Union and we had the peace dividend, we were able to accelerate globalization and building things. And that's one of the fundamental reasons why we had deflationary pressures for the last 30 years, that whole movement towards supply chain navigation and lower prices. I would say 10 years ago, the rise, whether you call it nationalism or the rise of this belief that we have to focus on communities that have been devastated by globalization. We need to find ways of creating better jobs for more Americans. That in itself is inflationary when you move away from the cheapest price ever to another area. And so that's a fundamental change. We change our immigration policies, and I'm talking about legal immigration, okay? Our legal immigrations, that was changed about 5 years ago, where we have reduced the amount of legal immigration. If you look at the rate of increase of immigrants, legal immigrants in the United States from 2000 to 2017, and the rate that we are growing immigration in the last 5 years, we're down 2 million. 2 million new entrants to the United States legally. Right. That is very inflationary when we have full employment, when we have these jobs. Think about all the need for workers. What is that going to mean when we start implementing our infrastructure bill, when it's going to take up quite a few new jobs? Where are those employees going to be coming from? It's going to create rising wages. And if you look at earnings, many companies are saying rising wages are a part of their degradation of their margins.
And maybe to add to that, we're also going through an energy transformation globally.
Totally.
And that can't be free.
And I've said in my letters that energy transition can be highly inflationary. And I've always said that an energy transition must be fair and just. And we can't be just mitigating supply. We need to be finding solutions. So we have a strong view on that if we don't find a way to be working with the hydrocarbon companies, with the energy companies, making sure that we have adequate global supply of hydrocarbons at the same time, move technology to create a more decarbonization platform and pathway, and it's not going to be a straight line. It's going to be lumpy like what we're seeing now. So that is also inflationary. And let's be clear, the $7 trillion, I want to underscore, $7 trillion of fiscal stimulus during the COVID years is beyond any stimulus we've ever seen in fiscal policy in our history of a country. So you add all those things up, it was a foundation of inflation. And then you overlay the Russian-Ukraine war and the supply shocks, and then you overlay now COVID and the lockdowns and what it's doing for supply chains. All of that is adding on. So getting back to the Federal Reserve and your question, the Federal Reserve does not have tools to fix supply problems. The Federal Reserve's tools, like every other central bank, is to reduce demand through higher interest rates. As I said, I don't think we have a demand problem. We have a supply problem. And so if they are if they believe they have to change demand, that will put us into a recession. And I believe we need more time. So I'm under the belief we're going to have a 2-year period of time of elevated inflation. But I do believe as we reconstruct our supply chains, we find better sources of energy in the interim, as we create more decarbonization technology, all of this in 3 or 4 years is going to work itself out. And when you talk to the energy complex of today, they believe fair value for gas, for oil, is about $70 to $80 a barrel.
Right.
And so we've seen this before. We're in this transition, and I do believe within a few years we'll be back to $70 to $80 oil.
Given all of that,
yeah,
is it realistic to have a 2% target on inflation? Or are we actually encouraging the Fed, in a sense, to do something that will drive us into recession? Because given there are fundamental factors that push that number above 2%, should we be really rethinking? And what does that mean for investors if we're looking at a 4% inflation world?
Well, I think we are living in a 4% or higher inflation world for the next 2 years. Investors are going to have to look beyond this period. The question is, what will happen in 3 or 4 years? Is this going to be a short-term pop? I mean, you even heard one of the governors yesterday talk about, we need to raise rates a few more times, and then I can see in a year we're going to lower rates. Okay, and so in my opinion, we need to get to a 2% level, just to level set, and let the data determine where it is. But I do believe, because this is supply generated and policy generated, not as much monetary policy generated, it's hard for them. If they overshoot, we'll definitely get into a recession, and then they're going to have to ease very quickly, and we still may have the supply problems. And in all the conversations I have with business leaders around the world, and I've had a couple meetings in the last 2 days with some significant CEOs of major international companies, and they're all talking about the supply problems, and they're also talking about the need of labor, and they're all seeing this problem, and it's a real big issue.
One other thing that you've been outspoken on, and that's environmental, social, and governance, ESG investing, and it became quite the vogue. At the same time, now it's getting a little bit of tarnish on it. For example, on some of the greenwashing allegations that we saw, certainly with the DWS, but also the SEC going at it. What do you make of greenwashing, and what should be done about that as a problem?
Well, I could tell you what we've done. We've always believed this could be data dependent, and so we've been very aggressive in building out analytics and data, so we could look at and review and judge companies through the lens of better understanding of how companies move forward in a decarbonizing world. We overlay satellite imaging and technology to understand how physical climate risk can impact an asset, a piece of real estate, an office building, a factory. And so we believe we cannot move forward without a proper taxonomy. And I do believe the SEC has to be focused on that. But importantly, let's be clear, clients in Europe are actually more aggressive on moving towards sustainability, not less. Europe right now today, they have the existential problem of Russian dependency of gas and oil, and they're moving away from that. Europe actually said we're going from 2050 to be net zero to 2035. And so in actuality, they're accelerated their decarbonization process. At the same time, Europe did change their taxonomy. A year ago, their taxonomy said gas was brown. Magically now, because of the problem, gas is green. And David, I've always said the energy transition is not brown to green. It's going to be from dark brown to medium brown, the medium light brown, the light brown, and on and on and on. We may develop new technology to leapfrog a couple of those shades, but I can't see that technology yet. But let's be clear, to do this transition, and the problem is some environmentalists are saying, Larry, we don't have time to do that.
Right.
And there lies the debate. Do we have time to go from dark brown to medium brown to light brown? We could all debate that. The question is, do politicians have the time to allow that? And there lies the construct that we're living in today.
And what's the best way into this problem? Is it through government regulation, standardization of these standards, or is it through things like shareholder initiatives? I mean, you said you're not going to back as many, I think, at BlackRock as you have in the past. We're going into the proxy season now. Do you anticipate backing any of those ESG
so
initiatives?
We're almost done with proxy season. In fact, in the U.S., we're done. We still have a few more in Japan. what we said, we're not going to be as prescriptive as last year. We're almost at the same level we were last year. I think the biggest change in proxy season this year, more and more companies are volunteering information. So there were much less issues in proxies this year. We worked really well with companies around the world. There was only a few companies where there was a large disagreement. And so I think people are, once again, are conflating the facts. The facts are, we said, and I've always been loud on this, we are not going to support Scope 3 at this time. Right. And the reason why, I don't want to be the environmental police. I think it's wrong to ask the private sector to tell all the entire society we have to move forward. And I have no problem in doing Scope 1 and 2, but we've always said Scope 3 is forcing big companies, banks, and asset managers to be the environmental police. And I've been loud about this. I've spoken about this at COP26. I'm against this. A lot of people got angry at me. But I believe there are some strong merits. But let me be clear. The energy companies and all the attending companies, they're moving. And they're moving with a deep understanding. And there's not an energy CEO who does not believe we have climate risk. And they all, they may disagree in the speed in which we could fix this. But I was with a bunch of energy companies recently, and they're all trying to focus on how do we create carbon sequestering, how do we create carbon capture. This is going to be a big thing, and every energy company is focusing how can we make hydrogen cheap enough to be a major source of energy.
One last one, Larry. You spend a fair amount of time talking to our leadership in Washington, as well as other capitals around the world. Right now, I think it's fair to say the Biden administration has got a challenge on its hand when it comes to the economy. It's not getting a lot of credit, whether it should or not. If you were to give them one piece of advice about what to do right now that could make some difference in the short to medium term, what would it be?
Fix immigration, for legal immigration, and I think we all would have said that. If you talk to all the business roundtable, the U.S. Chamber, I mean, we have to be really focused on things like that. We can build America back. But if we're going to build America back in a non-inflationary way, if we're going to grow America, we're going to have to do that not just with our own. We're going to have to allow legal immigration. We could bring, we educate over, a few million young people every year in advanced degrees in America, and it's harder and harder for them to get a green card in America today. We need to rethink about, the foundation of America. The foundation of America was on immigration.
Not catch and release, catch and keep. Right?
We're educating and letting them go. That doesn't sound like a good policy to me.